good evening, good morning, good afternoon, wherever that you are, or yes, good evening. So we'll be starting with next topic, that is buyback of securities. Earlier, no sir, if you are referring to some old books, the topic name is buyback of securities and equity shares with the differential rights. There was another topic attached to this here. It had two sections. That shares with the differential rights wala topic has been removed from the new syllabus. Hence that particular portion. That was a little bit of a theory and one small application was there as a numerical question was there. That portion has been taken off from our syllabus, so we don't have to worry. Now we just have to concentrate on buyback of securities. Is that okay? All right. Sir, buyback of securities simply means the company has issued some equity shares which they want to buy it back or cancel. Sir, equity shares, if company has issued, do they have any obligation? Does the company have any obligation to return equity shareholder ka money? Like company has taken, let's say, 10 lakh rupees from a few shareholders. Does the company have an obligation to repay this 10 lakh back? No, because equity shares we refer it to as permanent capital. Yes or no? But however, if company wishes to do so, if company want, they can buy back the equity shares. That is totally their choice. Is it okay? So in this particular chapter, the company has exercised or they want to go for that or they want to make that particular choice. All we have to do in this particular topic is we have to pass journal entry for such a buyback. Because of this buyback, what and all will change or how and all we need to give accounting effect. That is one aspect, basically the journal entry. Another aspect is balance sheet. That's all. Like internal reconstruction, even this particular topic or scope is also very simple. Journal entry and balance sheet. Easy. A company has done a buyback. All we have to do is give its accounting treatment or accounting journal entries. Yes. All right. Sir, left, right, center, you cannot do the buyback. There are certain limitations or there are certain conditions. Condition is a specific type of a problem. If I have to say from this topic, there are broadly two types of problems that you could encounter. One is the normal. They will tell this much shares has been bought back. All we have to do is pass journal entry and balance sheet. That is one kind of a problem. Another type of problem is they will tell you how much maximum shares can a company buy back. That is another type of problem wherein you need to keep some conditions. These conditions are not specified by our mother body or IC or anybody. These conditions is specified in Companies Act of 2013. All right. That aspect for the time being, I'll ignore. We will directly dive into the first type of problem wherein we directly dive into or giving the accounting effect for buyback itself. Is that okay with you? All right. So to go one step back, sir, normally why do the companies do the buyback? One plain reason could be company has enough money. Company has enough money. They don't have expansion plans. That means what do you think they can do with this money? They may declare a dividend. Still some money is left. Then company is saying if you go on declaring dividend, right? Every year you're going to get money only. No? So the company may take a call that when we needed the money to run the operation, when they needed money, who gave the money? Equity shareholders. Now when the money is not required means you can give back this money to equity shareholders. That could be one of the reasons. Theoretically, generally, practically no company does that, but theoretically this could be one of the reasons. Yes, company has a surplus money and what to do with that surplus, company has no specific plans or no specific ideas as such. That could be one. Or the normal reasons why companies do buyback is to avoid the hostile takeover. Like let's say over here, there is one company X Limited. In this X Limited, sir, let's say the promoters are the company who, or promoters are the people who start this particular business. Promoters and others. Let's say, sir, company has 1,000 shares. In this, let's say 600 shares are held by promoters and 400 shares are held by others. That means, can you tell me the shareholding percentage of this company, sir? Totally 1,000 shares. In that promoter is holding 600 shares means promoter ka shareholding percentage will be 60% and others ka will be 40%. Yes or no? Correct? Okay. Now, like what happens, or if you take the other scenario, that may be probably relevant. Let's take this to be 400 and make that to be 600. So in that the percentage in that case will be how much, sir? Here it will be 40%, here it will be 60%. Sir, who put in their efforts and started this company from the scratch? Promoters. Correct? Do you think any promoter would like to be thrown out of his own organization which he built with so much of energy, efficiency, enthusiasm? No. But sir, companies works with a simple principle, which is what? Voting power. Whoever has the highest voting power, that guy is the king or the kingmaker, whatever. Yes or no? Now you check over here. Promoter is holding how much? 40%. Others are holding 60%. Let's say one guy, Mr. Z came. He told promoter, sell your 40% shares to me. He directly gave one call to promoter and told, give your shares to me. Promoter told, no, I don't want to sell. The Z gave lucrative offer. 100% bonus also he gave. He like, if the share value is, let's say 1 crore, the Z guy offered 3 crore rupees for that. Still promoter told, I will not sell. It's my company. What do you think Z can do here? Okay, if you don't want to sell, no problem. There are others. He can approach others and try to buy it off. So if others sell to Mr. Z, in that case, Z will have how much shares in the company? 60%. Okay. Now if you want, he can cut off the promoters from the board of directors. Quite possible. Yes or no? So do you think any promoter would like to land up in this particular scenario? No. So what do you think they will start doing now? Initially, when they wanted money, they have to take money from the others. But now when companies slowly start getting more and more money, would they like to increase this others ka share percentage, or would they like to reduce this as much as possible? They would like to reduce this others ka share percentage as much as possible so that some hostile takeover can be avoided. This is generally one of the reasons why companies do the buyback. Are we okay? So two things you can write over here. One, buyback is done to increase promoters ka share percentage. Okay. Another reason is to avoid the hostile takeover. You don't have to write. Everything is given over here. All right. So these are some of the reasons why the companies opt for buyback. May not be that important. Just discussing. That's all. Okay, sir. Doubt, sir. Proceed, sir. Yeah, it's like Steve Jobs. Apple was thrown. Oh, yeah. Steve Jobs, yes, is a perfect example. He was thrown out from his own company. It has happened to millions of people like that. Not just Steve Jobs. Many people.
So they should have 51% minimum.
Not necessary. Sir, if you're talking about big companies and all, like if you talk about Reliance, I don't think so Mukesh Ambani owns more than 30 or 35%. Big companies, no, sir. You can't own like so much also, right? Because a lot of funding or a lot of money would be raised from the public, general public. When you're talking about like $100 billion, $1,000 billion, right? Or not, 1,000 maybe too much. $100-200 billion company, one person cannot own more than 50-60%. That is pretty rare. Can be, but pretty rare. If you just check the richest guys, right? Their company may be the valued, the biggest company in the world, but the shareholding that they will have in the company will probably be 25-30% at best. So to avoid all those scenarios, they kind of do this buyback if they want to do it. Okay. All right. Now you got to know the reason for buyback and meaning of buyback. All right. Let's dive in, or maybe 1 minute. I'll give you a little bit of extra logic behind this, and then we'll go for problems. Sir, as far as buyback is concerned, sir, you can do the buybacks in 3 methods. There are 3 particular permutations and combination, or you can call it as 3 methods. One, I'll call it as profits. Another one, I'll call it as shares or new shares. Third one is combination. I'll write. No need to write anything, just watch. That's good enough. Sir, let's say a company, let's say this is the balance sheet of X Limited. They have equity share capital of 10 lakh rupees. They have a P&L balance of, let's say, 30 lakh rupees. Let's say they have a bank loan of 5 lakh rupees. Okay, I'm not bothered about the asset side. Leave it. Just concentrate on what I'm doing here. Sir, what is the topic name? Buyback of shares. When you buy back equity shares, existing equity share capital will be same or it will reduce. It will obviously reduce, right? Okay, sir. Right issue. No. Concentrate on this, buddy. Don't sway away. We'll talk about the other things later on. Concentrate on this so far. Don't switch to the other topics now. Come back to this. Other things we'll take it later. Okay, the topic name is buyback of equity shares. So when you do the buyback, equity share capital will reduce. So there are certain limits for it. You can't cancel 100% of equity shares. There is obviously some limits. I'm going to ignore those conditions only for the sake of example. Let's say company did a buyback, 100% buyback they did. So what is equity share capital now? 0. Not possible, just for hypothetically, only for the sake of explanation, I'm saying this. Okay, sir? So 100% of the equity shares bought back means the equity share capital has become 0. Okay, sir? Now you tell who in this particular setup, who are the owners, who are the outsiders. In this particular example that I've given you, who are the owners of the company, who is an outsider as far as the company is concerned. Like equity share capital and bank loan. From this perspective, can you tell me? Equity share capital belongs to equity share holders. They are the owners of the company. So equity share capital belongs to the owners of the company. But bank loan is whom here? Outsiders. Can I call it like this? Equity share capital is an entitlement of owners, whereas bank loan is an entitlement belonging to an outsider. Now you think logically, sir, if a company shuts down, okay, if any company shuts down, ideally who should be paid their money first? Who should get their money first? Owners or outsiders? Outsiders. So in this example, equity share capital, bank loan. Who is an outsider compared to these? Bank. Sir, equity share capital you are buying back, meaning you're making it as zero. Did the bank loan, did you repay or is it as it is? As it is. Is it fair for the bank loan people or outsiders, this particular arrangement? Owners ka money you are giving away, but bank loan ka money you have kept it as it is. Is that fair? No. Because, sir, company has unlimited liability or limited liability. In case of a company, it has a limited liability. If things go bad, can bank loan people go to equity shareholders ka house and tell, from today onwards, your house is my house. Your jewelry, my jewelry. Your, I think you got the point. Yes. Can they do that? No. Because, sir, the company has a limited liability. If shareholders have paid the money means on their shares, can you demand even a single rupee extra from the shareholders? But if something goes wrong, bank people will be full Tirupati toss. I mean, this arrangement is totally incorrect. Yes or no? Without repaying outsiders' money, a company is repaying the owner's money. So this scenario is unfair. Hence, they brought in a small concept called whenever a company buys back their equity shares. This concept holds good for redemption of preference shares also. When you cancel equity shares, we use the term buyback. When we cancel equity shares, we use the term as buyback. When you cancel preference shares or preference shares, shareholders come money if company is repaying. That we call it as redemption. Meaning is same, just the terminology is different. For preference shares and debentures, we use the term redemption. For equity shares, we use the term buyback. Earlier, redemption of preference shares and debentures was there in our account syllabus. Now it's been pushed to CA Foundation. It's not there in CA Intermediate. So that's the reason I'm just telling you this. Are we okay? Yes. All right. Now, coming back, whenever you redeem or whenever you buy back equity shares, Companies Act, not accounting standard. Companies Act says you need to create one reserve called CRR, Capital Redemption Reserve. Whenever you buy back equity shares or whenever you redeem preference shares, even preference shares is capital, no? Whenever a capital in the company is going down or if it is decreasing, every such company has to create one reserve called CRR. Full form is what, sir? Capital Redemption Reserve. Why do we need to create CRR? With an intention to protect this bank loan people. CRR is created with an intention to protect bank loan people. Sir, how does creating one reserve protect bank loan people, sir? Sir, CRR is created from free reserve. CRR is created from free reserve. Free reserve means that reserve from which you can pay dividend. That reserve from which you can pay dividend, we call it as free reserve. Now you tell, sir, from P&L, can you pay dividend? Yes. From using P&L, can company pay dividend? Yes. So is P&L a free reserve? Yes. Is P&L a free reserve? Yes. If you want to create CRR, you have to create it from free reserve. Now, sir, how much capital went down? or how much is the reduction or gap in capital, sir? From 10 lakh, it became 0 means how much is the reduction in capital? 10 lakh. That means you need to create CRR to the extent of 10 lakh rupees. And CRR you create from what reserve, sir? Free reserve. In this example, what is that free reserve which is available? P&L. That means after creating CRR, do you think P&L will be 30 lakhs only? No. From 30, it will reduce by 10 and it will become 20. Is this okay? Now check, sir. Before this buyback, how much dividend could have been paid by this particular company? Before this buyback, how much maximum dividend company could have declared? 30 lakhs because P&L balance was 30. Now you check, can company declare 30 lakh of dividend or only 20 lakh max dividend? That means that 10 lakh is getting blocked. That way the interest of bank loan people gets protected. This is the intention. Are we okay, everybody? Yes, we don't have to know this. This is only for your reference. In our question, the problem will be, they will tell you how much CRR do we need to create. For that, we need to pass some journal entry. For this, I'm giving you a little background. Did everyone understand here? Let's go one step back again. Online also good? Till you're online also good. I'll give you a recap. Before that, give me a confirmation, people. Okay, awesome. So the topic name is buyback of equity shares. Buyback of equity shares means company is cancelling equity shares or company is paying back equity shareholder ka money. So one of the methods of buyback I told is what, sir? Profits. First method. So whenever a company cancels or reduces its capital or whenever they do a buyback of equity shares, every such company has to create one reserve called CRR, Capital Redemption Reserve. All right. Why is CRR created? To protect the interest of the outsiders. Could be bank, loan, creditors, whoever. To protect their interest, we create CRR. And CRR we create from what reserve? CRR is also a reserve. But this reserve is created from what reserve? The CRR is created from free reserve. Free reserve means what? That reserve using which you can pay dividend. Any reserve from which you can pay dividend, we call it as free reserve. In my example, the free reserve is P&L. So when you create a CRR, the P&L balance or free reserve ka balance will reduce and CRR ka balance will increase. So since the P&L balance is reducing, the funds get blocked. That way, outsiders ka interest gets protected. That's okay. Sir, if the 10 lakh was parked in CRR for the repayment of capital, isn't it like protecting the shareholders? It's not like more like protecting the shareholders. It's more like protecting the bank loan people. Because, no, sir, CRR is not there. If you have CRR, no, it can be used only for one purpose and one purpose only. That is to give bonus shares. If you have a reserve called CRR, it can be used only for one purpose and that is for giving bonus shares. Bonus shares topic was there in your accounts. Again, that's been eliminated, but unfortunately you have problems around bonus shares in this. So that also we'll target. Don't have to worry about that. Okay. So yes, this is the intention. Everyone good? So if you have understood this, can I build up the other scenario? Go on.
Sir, what are the other examples for free reserve?
Could be general reserve could be one example. Generally we see dividend equalization reserve. You create dividend equalization reserve is a reserve created to distribute dividend. Okay, generally in our problems, in all our problems you see, we'll only encounter two free reserves. Either a general reserve or a P&L. Okay, but any others also is acceptable. But we may not see it in the problems. Sir, after buyback, if company made bonus shares, then outside interest not protected. 1 second. You are about 4 problems or 5 problems ahead of me. Little slow much. You'll have to give me some time. Okay, I'll catch up with you. That adjustments will come. Bonus shares, redemption of debentures, redemption of preferences, everything. Chow chow baat is there in this. We will do it. But a little later. Just another maybe 1 or 2 hours you may have to hold on to it. It will come. Then you ask, I think probably your question will automatically get sorted. Let's wait there. Okay, if you understood this, I like to build up another example. Same thing. Balance sheet of X Limited. I'm taking the second method now. So first was a method what, sir? Is the AC is off? That side, Don't want it, is it? Because here, the side, it's like full daga. Maybe you can actually, like, if possible, you can, the vent, you can face it a little this side. So that you don't get that, You can freeze it, I think. Probably that will be better. Okay, all right, come back. Come back to this now. Look at this, people. Equity share capital. I'll give you another example. If you have got the previous example, you will tell the answer for this question. Okay, let's see. Equity share capital still 10 lakh. P&L balance still 30 lakh. Bank loan balance still 5 lakh. Company is doing a buyback. They are doing 100% buyback. Is 100% buyback acceptable as per company law? No. This is only for the sake of example. They did 100% of buyback. That means equity share capital after buyback will become 0. Okay. All right, sir. Sir, they issued new preference shares. Very, very hypothetical, but just the books says it. Theoretically, it is there. Practically, very, very outdated or irrelevant, I would say. The company has given new preference shares worth 10 lakhs, sir, and they have bought back equity shares. Company wants to look at this ridiculous method. They want to cancel equity shares, but by issuing new preference shares. So it does not mean to equity shareholders you are giving preference shares. No. Company is just issuing preference shares. Whoever wants can buy it. And how much preference shares they have issued, sir? 10 lakh. Currently, the company did not have any preference share capital is what I'm assuming. Okay, now they had only equity share capital of 10 lakh, which has been bought back means that equity share capital has become 0. Equity share capital has become 0. Company has issued new preference shares worth 10 lakh. New preference shares has been issued. That's all. That's all I said, Gautami. Nothing else. New preference shares the company has issued. Whoever wants it can buy it. All right, because again, to do the buyback, company has to pay the buyback means you can't cancel the shares and keep quiet. No, you have to pay the money back to equity shareholders. So if you have any fund shortage, you could raise that money by issuing new preference shares. Could be. Yes. All right. Now you tell if a new preference shares have been issued, equity share capital has become 0. Will any extra thing come? Yes. Preference share capital will come to the extent of 10 lakhs. Are we okay? Because company has issued new preference shares means preference share capital will increase by 10. Now can you tell me how much CRR will you create? How much CRR you will create? I told CRR is created from free reserve for reduction in capital or to fill capital gap. How much ever capital reduction has happened or how much ever capital gap is there. To fill that gap, we create CRR by using free reserve. That's the funda. Now just check this and tell me how much CRR you will create in this particular example. Equity share capital was 10 lakh before buyback. After buyback, it has become 0. So has capital reduced? Yes. So how much extent it has got reduced? 10 lakh. So what is the gap or reduction on capital at this point of time? 10 lakhs. Now, did you issue any new preference shares? Yes. To what extent? 10 lakh. So is still capital gap 10 lakh or it has got filled? It has already got filled. Yes. No, earlier the gap equity share capital was at 10 lakh. Now also capital is 10 lakh. Is there still any gap in capital? No. So is there any CRR required? So in this particular case, the CRR that you will create is 0 because anyway capital is already there. That way. Got it, sir? Need a minute, sir? Online also good? Okay, awesome. Third scenario is not really a method, it is a combination, meaning partly profits, partly shares. Like in the first case, you used, did you issue any new shares in the first case, sir? No, you used entirely profits to buy back capital worth 10 lakh. In the second case, you issued new shares, new preference shares to the extent of 10 lakh and you bought back equity shares. Third is a case where you use partly profits and partly new shares. Let's say we used profits to the extent of 7 lakh. We gave new preference shares. We gave new preference shares worth 3 lakh. Then we did the buyback. Let's look at the balance sheet now. Same equity share capital is still 10 lakhs. P&L balance is still 30 lakh. Bank loan is still 5 lakh. You did a buyback, so equity share capital has become 0. All right. Now you tell me, sir, what and all I need to do? Should I have to bring in any preference share capital into the picture now? Should I have to bring in preference share capital? Yes. Since the company has issued new preference shares capital will come in for 3 lakh. Now can you tell me how much CRR you need to create? Everybody, how much CRR we need to create in this particular setup? Unanimously 7 lakh. How, sir? Capital was 10 lakh before, it has become 0. So the reduction in capital or gap in capital is 10 lakh. When you bought back, the reduction in capital gap is 10 lakh. Since preference share capital came in for 3 lakh, how much gap is already covered up? 3 lakh gap is already covered up. How much reduction is still happened or how much gap is still remaining? 7 lakh. That means now you need to create CRR to the extent of 7 lakh to fill this particular void or fill this particular gap. That's all. Are we good? Okay. So this is all they will ask in your going forward 4 or 5 questions. This is one of the important adjustments. That's all. Okay, sir. All right. Most probably you will get this particular setup in examination. Okay. This and all is pretty rare. Okay. Because you think naturally, sir, equity shares, preference shares. From company perspective, which is more risky? Preference shares. Because preference shares, you have to give periodic dividends. Because we have studied all this in CA Foundation. Unless otherwise mentioned, preference shares are always cumulative. Cumulative means dividend goes on accumulating. Yes or no? But on equity shares, does company have any obligation to repay the capital? No. Any obligation to repay the dividend? No. That means which is better? Compared to, from that perspective, preference shares is little more risky. Yes or no? But you could also argue that preference shareholders don't get any voting power. So if you issue preference shares, there will be no any dilution of capital, meaning promoters' shareholdings will increase. That can also be put forth. So depending on case to case, they may do it. Okay. But generally, you see this particular setup coming in mostly in examination. But anyway, I've covered both. So you know what to do in all the cases? Yes. Okay. The point where you said CRR would protect the third parties. I would not get that point. Remaining 20 lakh is still free reserve. No. See, when here, no, how the interest is protected is you can't utilize CRR for any purpose. Once you create CRR, right? If you want to utilize CRR, it can be used only for one purpose only, which is what? To give bonus shares. So bonus shares means equity shares. If you want to utilize CRR, you have to give away bonus shares. Meaning if you want to make the CRR 0, no, you have to issue equity shares. So if you issue if you issue bonus shares, again equity share capital will increase by 10. Now you think if you have some money invested in your business, would you take the decision prudently, wisely, or left, right, center? If you have invested some money into any company, just like that you will do, bindas you will be, or you will be little cautious. You'll be little cautious. So if you want to make CRR 0, you have to give some extra shares. That means for the company, it will become equity share capital. Who will receive these equity shares? Shareholders. So if shareholders have received some money, some extra shares means, will they vote left, right, center, or they will vote cautiously? They will vote cautiously. That way, do you think outsiders' interest is gone or it is little protected? Protected. This way, it gets protected. That's what they say. Okay, now. Can I proceed, people? Kirtana, is your doubt sorted? Can I move on? Prophet confirm? Yes. Okay. So we'll move on to the questions now. That's all with respect to the things. So we'll dive into one point to keep in mind. There are some theory aspects also over not that important for exam, just that we need just quick run through we will give. Before you solve the problem, one point always we will check. If you want to do buyback, no sir, Companies Act says if you want to buy back any equity shares, they must be fully paid up. They must be what? Fully paid up. So if you have any calls in arrears or anything, such shares cannot be bought back. Okay. So just check that. Most probably that adjustment I've not seen ones also coming in, but just say. Okay. Those adjustments generally they used to ask it in redemption of preference shares, but that redemption topic is totally gone now. So I think I don't see the impact of that here. We'll see, but still we will always check that and then proceed. Can I dive into the problem? It's condition. It's condition. See, these some are rules. Okay. I didn't frame the rules. Right? So these are some rules. They must be fully paid up. And moreover, you're giving back the money, Alright. Why probably they thought is, if somebody has a defaulted, calls in arrears means has the person paid the money or he has defaulted? Now, when you do the buyback, you are returning the money back to him. When he is not being honest and giving the money to the company, why should company give the money back to him? Maybe that's what the lawmaker thought and said only fully paid up shares has to be bought back. Could be the ideology. We don't. Those are the lawmakers' point of view. Alright. Fine. Theory we will discuss. It's okay. It's given over there. Don't worry about that. We don't require much of a theory here. Whatever, about 8 to 10 points is whatever is required. I brought it in the books and it's there in the chart book also. That is good enough. Don't worry about that. Whatever is important, I'll cover it. You can leave that to me. Okay, come to question number 1, everybody. So again, sir, this is a very simple topic. But the beauty of this topic is it could be easily attached to another topic also. It could get combined. So how they're going to ask is totally institute ka choice. Like this topic separately, you could get a question or they could merge and then ask a question also. We'll see. Anyways, we will know it and then you'll get to know how and all can it be asked. So let's start reading the question. M Limited furnishes the following balance sheet as on 31st March. All the numbers are in thousands. Same usual schedule 3 ka balance sheet they've given. Share capital, reserves and surplus, etc. For all of it, they've prepared notes. So I'll just look at this here. Authorized, issued and subscribed capital. How many shares do we have currently, sir? 3 lakh equity shares of 10 each, but they are fully paid up. So is the condition getting satisfied of Companies Act? Yes. So can company buy back such shares? Yes. We have preference shares also. Alright, we'll see what they're told. Okay, now capital reserve, revenue reserve, P and security premium, P and L. So revenue reserve is nothing but your general reserve. Sir, you can pay dividend out of general reserve also. So general reserve is a FR. FR as in free reserve. Is a P and L a free reserve? Yes. So general reserve and P and L is a free reserve. Security premium is backed by Section 52 of Companies Act 2013 and Section 52 of Companies Act 2013 says security premium can be used only for 5 purposes. And dividend declaration is not a purpose of security premium. Meaning security premium cannot be utilized to declare dividend. Now you tell me in that ground, is security premium a free reserve or not a free reserve? Security premium is not a free reserve because you cannot declare dividend out of this. Capital reserve also cannot be utilized for dividend declaration. It can be only utilized to set off capital losses if you suffer any. Okay. So hence capital reserve is also not a free reserve. Why am I stressing on free reserve here, sir? Because CRR is created from a free reserve. So that means we need to know what is free reserve. So we have identified in this problem, revenue reserve, that is your general reserve, and P&L account. Those are the free reserve data available. Okay, awesome. Next we will see, directly go into the adjustments. The company passed a resolution to buy back how much? 20% of its equity share capital at 15 per share. So for the time being, there are 3 conditions actually about how much maximum can a company buy back. For now, you can keep in mind as how much, sir? 25%. For now, think about this. I'll stress upon the conditions little later. As I told you, that is a type 2 wala problem. There are 3 conditions. So up to 25% a company can buy back. Up to 25% a company can buy back. So for now, you don't have to test that. It's okay. These are basic problems. We'll go for it. That is the maximum buyback. If company wants in a year, they can maximum buy back how much? 25%. In this case, how much is company buying back? 20%. So looks like they are within the limit. As I told, this is not the only condition. There are 3. So ignore that for now and go with the flow for the time being. All right. So and what price are they buying back these shares? 15 per share. Sir, come back to notes to accounts. What is the face value of equity shares? Sir? 10. Face value of the equity shares is 10. Is the buyback price? This is your buyback price? 10 or is it 15? 15. So company is suffering a loss here or are they making profit? Sir, face value of the share is at 10, but they are paying 15 to buy back these shares. That means company is giving extra. Why? It's a negotiation. Because shareholders have to surrender their shares for company to buy back. Shareholder told, if you pay me 15 rupees, I will surrender my shares. Otherwise, I will not give. This is a negotiation. It could be more, it could be less. Anything is okay. So here they've agreed that we will do a buyback at 15. A resolution has been passed. That means everybody has agreed that 15 rupees is a fair price for such a transaction. Normally, let's say even if the market price, if you just check, TCS I think did a buyback a few months back or something. Yes. If the market price is let's say 1000 rupees, the shares are traded in the market at 1000 rupees. The company will not buy back at 1000. Company will let's say give 1100. They will give a little extra so that the shareholder will be induced or they will feel good to go through with this transaction or surrender these shares. Otherwise, some of the shareholders may say, I don't want to surrender my shares. To make them surrender their shares, the buyback price may be a little higher. Yes, could be, may not be, it depends. Now, in this case, the face value is at 10, but the buyback price is 15. So, company is paying extra. How much is that extra the company is paying per share, sir? Can I say 5 rupees is the extra amount paid on one share by the company due to this buyback? For this purpose, it sold its investment for 30 lakh or it sold its investment of 30 lakh for 25. Sir, if you want to buy back means shares will get cancelled or share capital will get reduced. But company has to pay money to equity shareholders, no? To pay money to equity shareholders, company requires money. If they have less money, one of the way to raise money is to sell off some of the assets or investment, which they have done it over here. Some investment, they have sold it off. That's all. So they've done a buyback and they've sold some investment. All you need to pass is a journal entry. Very, very basic question. Okay, sir. Can we start? Watch out for one. Other things. In fact, one problem, if you properly understand, I think I would say 60 to 70% of the question done. In fact, that example only covered the most, but nonetheless. All right. Journal entries. Journal entries in the books of, which company is this? The books of M Limited. Sir, we'll pass the journal entry in a particular order only for class purpose. You can pass it in any order you like, but just to have a certain framework or some certain patterns set in mind, I will pass the journal entry in a particular format. So if you want, you can follow the same or you can break it also, absolutely no harm. First, sir, I will pass journal entry for any inflows. Any inflows. Now tell me, did a company receive any money due to this transaction? Yes. What is that? They have sold some investment. When you sell the investment, the company will receive some money. So first journal entry I will pass. Is it necessary you have to pass it like that only? No. Not necessary. Just for the sake of class, I am following this. Okay, now. Alright. What is the journal entry for investment sold, pa? Bank account debit. You have sold it for what value? 25 lakh. But investment ka value is how much? 30 lakhs. So the journal entry is bank account debit to investment. Bank account debit 25 lakh, investment account debit or investment account credit 30 lakh. Obviously journal entry is not matching because we made a loss. 30 lakh worth of investment we sold for 25 lakh. So we obviously suffered a loss of 5 lakh. Where will loss on sales? Don't say reconstruction account. Left, right, center, don't bring that. Okay. This is your normal question. So loss on sale, where it will go? P&L account. P&L account. Basically, this is your, or you can also write loss on sale. Loss on sale. And this loss on sale will go where, sir? Or directly debit P&L only. It's all right. Narration is simply being investment sold. Being investment sold. This is the first. Is there any other inflow for the company? Any other debentures did they issue? Preference shares did they issue? No. Any other asset did they sell? No. Now, sir, buyback entries. Buyback, no, sir, will have 4 entries. If you do any equity shares ka buyback or even if you redeem preference shares, same 4 entries will come. So the first thing, You are doing a buyback means will equity share capital be same or it will reduce? You're cancelling equity shares, but company is not showing it as equity shares. They are showing it as equity share capital. So when you do a buyback, equity share capital will reduce. What is the, or how do you record equity share capital ka reduction, sir? We'll write equity share capital account debit. Equity share capital account debit. All right. Multiple ways to calculate this. Sir, how much is your equity share capital in totality? Sir, all the numbers are in thousands. Is it okay, or you want me to present everything in thousands, or can we do it in, oh, here they give it in full. Is it okay we represent in, you want it in full or thousands? Full. Okay, no problem. Sir, what is the equity share capital? 3,000 and they have told 1,000. So you should add 3 more zeros to this. So equity share capital is 30 lakhs. 30 lakh is your equity share capital, sir. Entire 30 lakh are you cancelling, or only how much are you cancelling? 20%. So 25% is a maximum, okay? In this problem, they are cancelling only 20%. So either like this you can write. 30 lakh or 20% is how much, sir? 6 lakh. That is one way. Okay? Or if you don't like this, how much is the number of equity shares the company has? 3 lakh. The company has 3 lakh shares. An entire 3 are they cancelling, or only 20%? So if you do 3 lakh at 20%, that will be 60,000. This 60,000 is what? The value or the number of shares? Number of shares. So equity share capital, preference share capital are all shown at face value. And what is the face value of each share? 10 rupees. So do like this also, you will get what? 6 lakh. Whatever way you're comfortable, you can do it. So equity share capital account debit, 6 lakh. But hang on, are you paying 6 lakh back to the equity shareholders, or are you paying something extra? Face value of the share may be 10, but you are paying, what is your buyback price? Buyback price is 15. So what is your extra? 5 per share. Sir, if company is paying extra means for the company it is a loss or a profit? Loss. And what does our nominal account rule say? Debit all expenses and losses. So company has suffered loss over here. So should we credit that or debit it? Yes. So you have loss means or expense means you have to give it some name, no? Here we're calling it as premium on buyback. You're giving some premium due to buyback. So we give that loss ka name as what? Premium on buyback. That's all. So premium on buyback account debit. Done, sir? All right. How many shares? 3 lakh shares. How much are you cancelling? 20%. So which will be 60,000. 60,000 shares you are cancelling. And how much extra are you paying per share? Each ka face value is 10, but the buyback price is 15. So obviously the extra is 5 per share. So one share, it is 5 extra. On 60,000 shares, the extra is 3 lakh rupees. So premium on buyback is 3 lakh.
Can premium on buyback be replaced by SPR?
Next. Second journal. Little fast. You are. You can do it. You can directly debit security. First problem, no. I want everyone to get on par with that. Yes, you're right only. You can do it. So everyone understood this? Premium on buyback 3 lakh. Comfortable? Okay. So in totality, how much you need to pay now? 9 lakh rupees. Yes, no? This we will park it in equity share buyback account. Equity share buyback account. No, someone is saying, sir, why not bank? Sir, if you pass a resolution to do the buyback today itself you will give the money to all thousands or lakhs of shareholders, or there could be some time gap. Today you may pass a resolution to do the buyback, but ultimately its effect can be seen maybe within 1 week, 2 weeks or whatever. So there could be a few days ka delay. That's the reason temporarily we park that amount in what, sir? Equity share buyback account. Equity share buyback account. Some books also use equity shareholders account. That is also right. But our study material uses equity share buyback account. Just to sync up, we are using. Anyway, it's a dummy account. It will anyway get nullified. I suggest use the same better. Alright. So any problem until here or move on to the next? Narration is the same. Here they are passing. Study material is not passing. If you want, you can give a extra component like being equity shares bought back as per, I think here what resolution they passed. They only said resolution. being equity shares bought back as per resolution number or resolution dated ... You can write like that, but study material is giving a simple treatment saying equity shares bought back. That's all they're writing. When study material gives us a shortcut answer, you want more. So we will simply write the normal narration being equity shares bought back. Someone is saying explain it once again. Others copy. You are cancelling equity shares. So when you cancel equity shares for a company, it is equity share capital. Equity share capital has credit balance. To cancel it, we need to debit. Hence, I've debited equity share capital. All right. So the company has a 3 lakh equity shares here given in the question. All right. So they are only cancelling 20% of equity shares as mentioned in the adjustment. So 3 lakh ka 20% is 60,000. All right. And equity share capital is shown at face value. So one share ka face value is at 10. So hence 60,000 into 10, 6 lakh. Are we comfortable here till here? Someone who asked once again. Okay. The first point, 6 lakh. All right. Then, but are you paying 6 lakh rupees to the equity shareholders? No, you are giving extra because you are not paying on one share 10 rupees. You are giving on one share 15 rupees. That means you are giving 5 rupees extra. So that is a loss. And nominal account rules say loss to be debited. We are calling that loss as, or we are naming that loss as premium on buyback. Say 3 lakh shares in totality. We are only cancelling 20%. So 3 lakh or 20% is 60,000. So 60,000 shares is cancelled. And on each share, you're paying 5 rupees extra means 60,000 into 10, which or 60,000 into 5, that will give you 3 lakh. So in totality, you have to pay 9 lakh to the equity shareholders. One minute. Hang on. Let's do 2-3 problems. Then we'll take up hypothetical scenarios. Vignesh. Hang on. No, do 2-3 problems. Initially, only if we take, no, for others, it will be all sorts of confusion will get created. Little 2 minutes. We'll finish 1 or 2 questions. Then we'll take it. Okay, sir, premium on buyback is what? A loss. Normally, where do we transfer that loss to? P&L. But section 52 of Companies Act is targeting securities premium. And section 52 says, if you have done any buyback and suffered any loss, instead of transferring that loss directly to P&L, first you can adjust with securities premium. Sir, you tell, if you can adjust a loss with security premium versus you can adjust a loss with P&L, which option will you go for? You can adjust a loss with security premium, also with SP. Both are available to you. Which one will you choose? Securities premium, because security premium has only 5 uses. So it is a restricted reserve. Does P&L have any restriction? No. That means whenever you have a restricted reserve and when the purpose comes, you would like to utilize that first and then use the unrestricted one. Yes or no? So hence, whenever you get premium on buyback, first check, do you have enough balance in securities premium? Do we have enough balance in security premium here? First of all, do we have securities premium? Yes, this is 500. All the numbers are in 1000. So security premium balance is 5 lakh. Balance is 5 lakh, but the premium on buyback or loss due to buyback is only. So you have 5, but loss is only 3. Can you adjust entire loss with securities premium? Yes. So can you tell me what will be the journal entry for adjusting? Premium you have debited, that premium you have to adjust with or knock off with security premium. So what will be the journal entry? Perfect. Securities premium account debit. Security premium account debit to premium on buyback. How much? 3 lakh? 3 lakh. Narration is being premium adjusted or premium on buyback adjusted. There's a second entry related to buyback. Everyone comfortable till here? So I told whenever a company does a buyback, you need to, at the back of your mind, you need to keep one reserve in mind. What is the name of that reserve? CRR, as in Capital Redemption Reserve. You create CRR to what extent? To fill capital gap. How much ever gap has been filled due to this particular scenario, you need to fill it up. So did you cancel any equity shares? Yes. How much equity share capital have you cancelled? 6. That means your capital has reduced by 6 lakh. So there is a gap in capital to the extent of 6 lakh. Did you issue any preference shares? Did you issue any preference shares? No. So which method of this buyback we are targeting here? It's entirely profits. So capital has reduced by 6. So there is a capital gap of 6. So you need to create CRR also to the extent of 6 lakh rupees. Okay. What is the or which reserve will you use to create CRR? Here, all the 4 of them, or only 2 among the 4? One is the revenue reserve, another one is P&L. Generally, study material uses the revenue reserve first and then P&L. Actually, there are no order because both are anyway free reserve. If you want to sync up, we can also do like that. First, create it from general reserve. Revenue reserve is nothing but general reserve. First, use that and then use P&L. But if you ask me, there is no distinction. You can use anything according to me. All right. Now check, sir. Do you have how much balance in general reserve? 4,000. That all these numbers are in thousands. So we have 40 lakh balance in general reserve. 40 lakh. Yes. How much CRR do we need to create? 6 lakhs. So do we have enough balance in revenue reserve? Yes. So when you create CRR, revenue reserve balance will increase or it will reduce? It will reduce. CRR balance will increase. So reserve, where do you show in the balance sheet? Liability side or asset side? Liability side. So reserve has what sort of a balance? Credit balance. So one reserve if you are using means, and it has credit balance, and if its balance is going down means, what will you do? Or how will you reflect that? Debit it. Yes, no? So you'll write, what is the journal entry to create CRR now? Revenue reserve account debit. How much? 6 lakh. To what account? CRR. We'll write the full form here. One, capital redemption reserve. Capital redemption reserve. And going forward, we'll call it as CRR. 6 lakh rupees. There's a thing for CRR. So narration is simply being CRR created. Being CRR created. You can use P&L also, no harm. So free reserve balance will reduce, CRR balance will increase due to this particular transaction. This is the 3 entries. Yes, you can use SPR directly. Instead of premium and buyback, you can directly use SP also. I will not do that for 1 or 2 problems. Then I will start using that. You can do it. Yes, that's what your question also. You can do it. All right. The last entry for buyback is, sir, you did all this cancellation, but shareholder is only interested in one thing, which is what? Money. How much money you have to pay the shareholders? 9 lakhs. That 9 lakh you parked it in which account now? Equity share buyback. That's the name of the liability you have called. Can you keep quiet or you have to settle it? What's the journal entry for money paid off? Equity share buyback account debit to equity share buyback account. Buyback account debit 9 lakh to bank account 9 lakh. Being amount settled. Being amount settled. Or being buyback amount settled. That's all. So 4 entries towards buyback. 1 or 2 more entries for inflows. That's all as a scope. Okay. This we will encounter in almost every problem going forward. We have around 7-8 questions. We'll have to keep doing this. 1 or 2 new things may come as and when we read on the question. But so far, easy, everybody? Anyone wants me to wait? Any copying pending? Others who are already done with copying can read question number 3. Sir, Papa, you people are feeling very bad, no? Question number 2 is homework. A lot of questions are repetitive here. So few of them I'll give it as homework. Only those which are little different, I'll do. Okay, different means what? 90% will be same. Little bit, 1 or 2 adjustments may come in as a new. Okay, we'll go for question number, what did I say? 3. Come back. Okay, DD Limited, a non-listed company, furnishes the following balance sheet as on 31st March and all the values are in thousands. They've given balance sheet. Guys, hang on. That's what I said, right? Kind of keep your voice down. So yeah, balance sheet they've given and notes to accounts they've given. So they've given authorized, issued and subscribed capital. If you just check, we have 2,50,000 equity shares of 10 each fully paid. That means things are good. Okay, just check this. This is important. We have 2,010% preference shares of 100 each. Look at this word, very important. Issued 2 months back for the purpose of, you wanted to do the buyback. For buyback purpose only, this preference share was given worth how much? 200. All these numbers are in thousands. That means you have given preference shares worth 2 lakh. Do not forget this. This they have not given an adjustment. Purposely they have given in notes to accounts because this will have an impact on. This will have an impact specifically on CRR. CRR you create to fill capital gap. You might have bought back equity shares. That means there is a reduction in capital. But of 2 lakh worth of capital gap is already filled because of preference shares. It's not necessary that you have to issue the preference shares after buyback only. Before also if you are issuing for the purpose of buyback, that is good enough. Okay, this one you need to keep in mind. Next is reserves and surplus. Identify here, sir, what is the free reserve? Is capital reserve a free reserve? No. Revenue reserve? Yes. Security premium? No. P&L? Yes. Just in case you're wondering, this is auditor's tick, the ulta. When you go for audit, you will not put the tick mark like this. We'll put it like this. This is our tick mark, ulta. Ulta tick, yeah, that's how we vouch.
Why is that?
Just the norm. Just the norm. Maybe we want it to be a little different. Everyone put like this. CA course only is different, no? So we changed our approach on. And that too, we specifically put in, and we sign also in green, I think. Yeah, I think now it's changed or not, I'm not very sure. I'm hardly in the audit field now, so I'm not sure about the latest development. Generally, we use green pen. Just the norm maybe. Anyways, people will have their own fun done of identification. Maybe this is our identification, our mark. Okay. The company passed, don't worry, articleship is definitely an interesting phase and the current setup, no sir, I strongly believe in this. This is better. The things that we went through, no, it was kind of very hectic to be honest. Because when we went through, no, after foundation, we had to do articleship. So on one hand, studies, on another hand, job. So we couldn't give excuses to our teachers why we are bunking because they couldn't understand because we had a lot of pressure in work. Nor we could convince our boss because he used to say, studies is your job. For me, I'm concerned about my business also. So it was quite difficult. Majority of them found it very difficult to balance the two. That way, many of them used to miss out classes or bunk articleship. So neither you used to learn the work properly nor study properly. Everything was little haphazard. But now the setup is pretty good. First, complete your studies. Clear your CA intermediate fully. Then only go for articleship. 2 years, no leave, nothing. Learn the work properly. Because you are going there to learn. So if you're not doing that, then it doesn't serve the purpose. Nor yours, nor for your principal. So that means this setup is pretty good. So you'll also get a lot of time. In fact, they give you, after articleship, you'll get 6 months study break and then you can take up CA final. That means after articleship, you get 6 months solid time to study. That way your final ka burden also will get reduced because final ka syllabus is more voluminous compared to this. So that way you will also be at a little better position. So one, you'll have a confidence that you've learned a few things, what happens. And then you'll also have a little extra time to aram se sit and study and clear the examination and finally get that 2 magical alphabets, CA. Okay, so this is a wonderful setup if you ask me. Okay, so yes. So first for that magical phase, first we have to finish this particular magical problem. So let's do that. A company passed a special resolution or a resolution to buy back 20% of its equity capital at 50 per share. So go back to the question. What is the face value of the share? Equity shares. Just check what is the face value? 10 rupees. What is your buyback price? 50. So are you paying any extra? Yes, you are paying 40 rupees extra per share. 10 worth of share, you're paying 50. So extra is 40. For this purpose, it sold all of its investment for 22 lakh. Pass journal entries and prepare balance sheet. Again, in this topic also, 1 or 2 balance sheets we will do for further learning the format. Okay. Someone said, give me the recap. I'm giving you the whole problem as a recap. Okay. Yes. Many problems are simple over here. I mean, same. That's the reason. Okay. Can we start? That's all. Question number 3. Same. Journal entries. Journal entries in the books of B Limited. Okay, so you guide me, sir. What is the first, or how are we passing this journal entry? Oh, yeah. First, we are passing the journal entry for the inflows. Is a company getting any money due to these sort of transaction? Yes, we have sold some investment. Sir, how much did we sell it for? 22 lakh. And we sold all of the investment. So the journal entry is bank account debit. We sold it for 20. How much is that? 22 lakhs. Check your balance sheet, sir. What is the value of investment shown? The value of investment is 3,000. All these numbers are in thousands. So the investment ka value is 30 lakhs. Sir, 30 lakh of investment, we sold it for 22 lakh. So it's a happy or a sad scenario? Sad scenario, because we ended up making a loss. So directly can I write P&L account? So P&L account debit, in bracket mein I'll write loss on sale. Or you can write loss on sale account debit, in bracket mein P&L, your call. This time narration can I leave? Would that be okay? Basic narrations. One problem anyway I've shown you. This is a journal entry for the inflow or inflows. And then we'll proceed with the buyback transaction. In buyback, how many entries will come? 4. Simple. If you wanted in a recap, one entry is to cancel the capital. Another entry is to transfer the premium to either security premium, or if security premium is not there, transfer it to P&L. That's the second entry. Third entry is to create CRR. Fourth entry is to settle the buyback amount. These 4 will come. Or if you want, instead of directly premium and buyback, you can directly debit security premium. That way one entry can be reduced. That is your call. Still, I'll do it. One more problem. So you have done a buyback. So equity share capital will reduce. So the journal entry will be, since equity share capital has credit balance and it is reducing due to buyback, we will debit it. How much is the, check your notes to accounts. How many shares do we have? 2,50,000 shares. And can we cancel entirely? No. How much the company is wanting to cancel? 20%. So 2,50,000 cut 20%. Sir, buyback price is 50. Should I write 50 here?
No, sir.
Sir, equity share capital is always shown at face value. So cancellation also will happen at face value, which is how much? 10 per share. 2,50,000 cut 20% is 50,000. So company is cancelling 50,000 shares. 50,000 into 10 is 5. Alright. So face value of the share is the 10, but buyback price is 50. Is there anything extra? How much extra? 40 per share, because buyback price is 50, no? So extra is 40. So extra means for a company's perspective, it is loss or profit? Loss. That loss, what are we naming as? Premium on buyback account debit. Same calculation, 2,50,000 total shares. Of this, 20% we are buying back. And the extra amount is 40 per share. So this will be what? 4 times of this. So it will be 20 lakhs. Finally, how much we need to settle? 25 lakh. That we'll park it in a dummy called equity share buyback account, which is 25 lakhs. So premium on buyback is a loss. Normally loss goes to P&L, but before that, check. Do we have any securities premium? Yes. How much security premium we have? 2,200. All these numbers are in thousands. So the value is 22 lakh. We have 22 lakh in securities premium, but however premium on buyback is only 20. Can we transfer entire premium? Can we set it off with securities premium? Yes. So the set of entries, securities premium account debit 20 lakhs to premium on buyback, to premium on buyback account 20 lakhs. What is the next journal entry for? To create CRR. Sir, CRR is created from free reserve. Here we have revenue reserve. And first of all, you tell me how much CRR needs to be created in this particular project. Will we create CRR to the extent of 5 lakhs? Will we create CRR to the extent of 5 lakhs? 3 lakhs. Why, sir? Sir, we have issued some preference shares 2 months before buyback to the extent of 2 lakhs. So, though you have cancelled equity share capital worth 5 lakh, 2 lakh has been, gap is already filled up by creating or by issuing preference shares. So, the gap remaining is only 3 lakh. So, we need to create CRR only to the extent of 3 lakh. Sir, second entry on buyback, what you named it, just tell, I will note. Second entry, named a premium on buyback. Is there here on? What did I name? That's what I named. I didn't give any extra namakarna. Same. Okay. All right. So the journal entry will be, what are they calling it as? Revenue reserve, or this time general reserve? Revenue reserve, this thing. So we'll use revenue reserve. So the journal entry will be revenue reserve account debit. Revenue reserve account debit to CRR account. So I'll write it over here. 1 minute. Though the capital, equity share capital is reduced by 5 lakh. So the gap cost is 5 lakh. The company has issued some preference shares. They told in notes to accounts. This preference shares was issued 2 months back for the purpose of buyback. I mean, some preference shares has already been issued, means preference share capital has increased by 2 lakh. So out of this particular 5 lakh, 2 lakh capital gap is already filled. So the gap remaining is only 3 lakh, which you fill it up by creating CR. Now, okay, now someone said I didn't get. Can I move on, Gautami? Okay, you didn't understand. What is the problem? Here, simple, no. We have capital was 5 lakh, that much you got it. Equity share capital is reduced by 5 lakh, that have you got it? Confirm. This is okay now. 5 lakh is okay. All right. Sir, I told you before starting this problem, there are 3 ways you can do, 3 methods to do buyback. One is profits, another is shares, another one is combination. Here, have you issued any shares? Yes, you have issued new preference shares, no? Clearly told in the question only. How much is the preference share amount? 200. All these numbers are in thousands. So 200, if you present in 1000, that is nothing but 2 lakh, no? So if you have issued preference shares worth 2 lakh, means though the equity share capital is reduced by 5 lakh, preference share capital is increased by 2, no? So net mein how much gap is there still in capital? Though equity share capital is reduced by 5, preference share capital is increased by 2. So how much gap is still remaining? 3 lakh, no? Because this is 5 lakh reduction. Okay, this is 2 lakh increase, meaning this is the positive number. So how much gap is still remaining? 3 lakh. That we have created CRR. That's all. Okay. All right. So this is done. The last entry is what? The payment, which will be equity share. Equity share buyback account debit to bank account. How much settlement are you doing? What is that equity share buyback account ka balance? 25 lakhs. This is your settlement. That's all. Question over. I'll just see maybe for this one or okay, we'll do one balance sheet. It's all right for this. Not this one and maybe one more. I'll pick it up and do the balance sheet. And I think that's two balance sheet problems is good enough from this topic to understand the format. By now, I think you should have got the format, but still, nonetheless, we'll do one more. Okay, everyone has copied this. Can I start with the balance sheet? Online also? Yes. Okay, let's start with the balance sheet. Balance sheet of which company is this? D Limited. As on, they have not given any data. Existing balance sheet is on 31st March. When we did all this buyback, have they given any specific date? No. So you can keep the same date, 31st March 20x1, or you can simply leave it as blank, your call. It's all right. Sir, I will not prepare notes. I will prepare everything inside the balance sheet itself, because one, in the examination, you may not have time. If at all you want to prepare the notes, anyway, solution ka balance sheet has that. So that way you're comfortable. That's all right? Everybody? So I will not have any note column. If you're preparing a note, you should have a note number column. Otherwise, directly you can write all the amounts. Sorry? One or two will be lost. Definitely one or two will go. But that's all right. It's a time versus marks wala call many a times. So it's okay. But just for 1 or 2 marks, you should not like sacrifice one of the question itself. Some of them happens like that. They'll keep doing this, but one question only at the end they'll skip and come. So 1 versus 20. Which do you think is better? 20 is better. I'm not saying you should not prepare it. Take a call based on the marks. If you have time, do it. If you don't have time, do it like the way I'm showing. So both the approaches, be aware. Whatever you want to do in exam, accordingly take a call. Okay, for now, guide me. What is this heading? First, we will write equity and liabilities. And under equity and liabilities, point number 1. Shareholders funds. And under shareholders funds, point number A. Share capital. And normally you have to prepare note number 1 for share capital. Tell the sir you are aware what and all disclosures you need to give in note number 1. We've done this in one of the previous topic. 1, you need to disclose authorized capital. Another one, issued, subscribed and paid up capital. That information you need to give. How many shares you have, that you need to disclose. Like issued, subscribed and paid up capital. Under that you'll write 1 lakh shares of 10 each and write 10 lakh in the amount column like that. In this problem it may be different, but just say how to present it. Here directly I'll show it. What and all type of share capital we have here, sir? We have equity share capital. So check the question. What is the equity share capital given in the question? Or maybe check the notes to accounts. That will be better because in the balance sheet they would have given equity and preference. So check notes to accounts. How much is equity share capital given? 2500 they've given. You said you want it in full. So if you want to present in 100, you can take this number as it is. Otherwise, you need to reconvert. So if you reconvert, it will be 25 lakhs. So the number of or the value of equity share capital given in the question is 25 lakhs. Check your journal entry. Have you credited or debited equity share capital anywhere? So you debited equity share capital by 5 lakh. So obviously equity share capital due to buyback will reduce and it will become 20 lakhs. No? Okay. Then preference share capital. What percentage preference shares are these? 10% preference share capital. That there is no change. Check notes to accounts. How much is preference share capital? They've given 200. 200 if you write it in full words, it will be 2 lakhs. So total share capital is 22 lakh people. Yes, no, sir?
Yes, sir.
Can I move on to the next one? Which is what, sir? After share capital, it is reserves and surplus. Normally, we have to do a note number 2 for reserves and surplus and show how and all the reserves and surplus have increased or decreased. All that increase, decrease calculation, I'll do it here itself. So one by one, I'll call it out here only. What is the first reserve you are able to see in your notes to accounts? You are able to see capital reserve. How much is the capital reserve given, sir? They have given 1000, but you have to express it in, full value. All these are in 100. So it will be 10 lakh. So check your journal entry. Did we debit or credit capital reserve anywhere? No. That means its balance will still be after buyback. Also, its balance will be 10 lakh only. Next is what? We'll go in that order only. In the question, what have they given next? Revenue reserve. How much is the revenue reserve given in the question? They have given 3000, which is nothing but 30 lakh. Check, sir. Have you debited or credited revenue reserve anywhere? Yes. You created CRR from revenue reserve and you utilized how much for CRR creation? 3 lakh. So revenue reserve will reduce by 3 lakh because revenue reserve you have debited. No, reserve has credit balance. If you debit, its balance will obviously reduce. So revenue reserve is 27 lakhs. The next reserve is securities premium. How much is the securities premium given They have given 2200, which is nothing but 22 lakh. Check. I think we did get some premium on buyback, which we set it off at security premium. You have debited securities premium by 20 lakh. So security premium will reduce by 20 lakh and it will become 2 lakh. Then they have given P&L. P&L balance given is 35 lakhs. I think we sold investment at profit or loss. We sold investment at a loss of 8 lakh. So due to this loss, your P&L balance will reduce by 8 lakh. So your P&L balance will be 25 lakh. Or if you are 27, huh? Okay, 27 lakh is your P&L. Or if you are a forgetful type of people, then you can bring in, before you start with the reserve, you can bring off one reserve, that is CR. That will not be given to you in the question, but it has to come in your solution. So CRR, how much did you create? 3 lakhs. So CRR also has to be captured for 3 lakhs. So 30, 32, 39, 59, 69. No? Okay, 69 lakh is your reserves in surplus ka total. All right. Next in the question, sir, what have they given? They've given directly current liabilities under the trade payable. Did we change any trade payable? Just copy the data as it is. So second one is your current liabilities under the trade payables and the value is 14. That's all. No other value. So the total of your liability side is how much? 73, 83, 85, 105. Okay. Point number 2 is for your assets. Under assets, point number 1, non-current assets. Under non-current assets, point number A, property, plant and equipment. Sir, property, plant and equipment, did we touch property, plant and equipment? Did we sell anything? That means, will that value change or remain as it is? Here they've given 9300, which is nothing but 93 lakh. Its value will be same. Wait, some of you are still updating. Okay, right. Others who have done till here can proceed further. Show full law. Is it all right? By the way, all of you have completed your graduation, no? Or pursuing. How many of you are still pursuing your graduation? But majority of you are done. You're not doing at all. That's a better option. If you're very clear about CA, I think you should not waste your time doing something else. Have one degree. Okay, you can probably go for, I think ICA has a tie-out with many universities, IGNO and all. You can get it done there. Don't ignore BCom. Get that done. From which university is your call, but have it, because in case you choose to pursue any foreign course, no, they do ask for another credits. Like if you want to do CPA, they expect a certain number of credits, which CA will not fulfill. You need to get some BCom also. So better have it. Just do it in a correspondence way or a evening college or something where there is no requirement to go to college. I think that will be better. Okay, show assets. Showing. Okay, after PP, what did we have, sir? We had non-current investment. Will this come or it is sold off? Since it is sold off, it will not come. So next is your current assets. So the first current asset is what, sir? First current asset, they have given us inventory. Did we buy or sell inventory? No. So value is still same, 500, which is express full means it will be 5. Then trade receivables, that value is 2 lakhs. Cash and cash equivalents will change. Cash and cash equivalents. Sir, what is the given balance? They have given 800, which is nothing but 8 lakh. Check your journal entry. You sold investment and you got how much? 22 lakhs. That means bank balance or when we say cash and cash equivalent, cash in hand and cash at bank, both are included here. Both put together, we call it as cash and cash equivalents. So bank balance, when you sold the investment, it increased by 22 lakhs. And you paid some money, for buyback, you paid how much? 25 lakhs. So your cash balance will reduce by 25 lakhs. So that means the final cash balance will be 5 lakhs. So what is the total on the asset side now? Same 105 lakhs. Huh? That's balance sheet is very simple. Is it all right? Can we do one or two more and then take a break? Would you be fine with that? One minute. Let me see how much this will take and then tell you. Another maybe 10-15 minutes. Next question. That's all. Is that okay? We'll do one more and then that's all right, right? Okay. Come to question number 8, sir. Others also will do. Just that we'll start with question number 8 for now. kg. Correct. Ade. Why 22 lakh got added? You sold investment, no? You sold investment for 22 lakh. So bank balance will increase. No? That's the reason. Okay. Check your journal entry. Balance sheet, you simply need to check question ka balance sheet and journal entry ka effect you need to give. Due to journal entry, those balances would either increase or it will reduce. That's all. Balance sheet is very, very straightforward. You don't have to remember anything also. Take question ka balance sheet as it is, compare with the journal entry and figure out which account increased, which account reduced. That's all. Keep on doing like that. So you'll not go wrong there. Okay, come to this question, KG Limited one. 1 minute, I'll quickly. Yeah, I think this we can do. All right, KG Limited furnishes the balance sheet as follows. That's okay, the usual balance sheet. Notes to accounts mein, you're able to see equity share capital, but these are fully paid up shares of 10 each. So no drama, guys. All right, reserves and surplus. Security premium, is it a free reserve? General reserve? So CRR is already created, sir. Sir, each time you do a buyback, you need to create. Yeah. Is it necessary only once a company need to buy back? They might have done a buyback few years back also. And I told CRR needs to be created even when you redeem a preference shares. So for both buyback of equity shares and redemption of preference shares, CRR concept is same. So just because CRR is already created does not mean we will not create CRR. This CRR is for the old buyback or old redemption. If you are doing any new redemption or buyback now, again that particular buyback or redemption ka CRR has to be created. Done? Work. So is the CRR a free reserve? Sir, I told CRR can be used only for one and only one purpose, which is to give away bonus shares. Did I say CRR can be used to declare dividend? Free reserve means that reserve which is available for dividend declaration. Are you paying dividend out of CRR? No. So is CRR a free reserve? Is P&L a free reserve? Yes. Okay. Check this. On 1st April 20X1, company announced buyback of 25% of equity shares at 15 per share. So the face value of the share is 10. Buyback price is 15. So the extra amount which the company is paying is 5 per share. Not only we call it as premium on buyback. For this purpose, it sold all of its investment for 75 lakhs. Usual. Okay. Actually, if they had stopped the question here, this question I would have given it off as homework. Yeah, look at that excitement. Even probably you would have also cut off. Yeah. But unfortunately or fortunately, they added another para saying what, sir? On 1st April, you did this buyback. A few days later, That is 4 days later to be specific. On 5th April, the company achieved the targeted buyback. Okay, they completed the buyback is what they're saying. All right. On 30th April 20x1, the company issued one fully paid up equity shares of rupees 10 by the way of bonus for every 4 equity shares. So this problem also has some bonus adjustment. So bonus issue ka topic they have pushed it to CA foundation. It's not there in our CA Inter Syllabus anymore. It was there, but now it is not there. It's there in your junior side of things, not with you. But this adjustment, no, they're asking still. That means indirectly even we also should. No, because we neither learnt it in foundation. Because we are somewhere stuck in between. No, they say no, na gar ka na ghat ka type. We are that sort of people, right? Because we didn't learn this in foundation, nor are we going to learn it fully in intermediate. CA Institute thinking that you learnt this in foundation and asking this adjustment. No problem, easy only, all these are not a big deal. Okay, so that's what they're asking. So pass journal entry and pass the balance sheet. Balance sheet is something you will do. Okay, journal entry is something I do. Is it okay? One more problem, I'll take a balance sheet and show you. Anyway, I got the practice. That's all right. Okay, so bonus is only the extra pitting. Sir, what if buyback is more than 25%? Not acceptable. You can't violate, no? So don't worry about those conditions. What I say, we'll take up those conditions later on. Don't have to worry. In all these problems, conditions will be satisfied. It can't exceed, sir. It's a law. Like, you have to respect the law of the country. If you are a company, means you have to follow company law provisions. You can't say, I will not follow. If you don't follow, then there'll be some repercussions. You have to pay hefty fines. Auditor will issue audit report. Qualified opinion. Oh, auditing and all is not done. It's okay. Some consequences will be there, which may not be good. You may not like it in the long run. Okay, so which question is this now? Question no. 8. Journal entries. What a balcony there. Balcony is talking among themselves. They even will involve me also. What is happening there? Interesting conversation. Journal entries in the books of which company is that? KG. The first journal entry. What is that, sir? Is there any inflow? Did we sell any investment? How much value for? So the journal entry is bank account debit 75 lakhs to guys, we agreed, right? Some of them here will get disturbed. Slowly as I talk, I'm not preventing that, but just since the classroom is little, the earlier classroom probably could have gotten away because it's on the lengthier side, no? But here the noise kind of travels faster, so dim it down a little bit. Okay, investment, you sold all of its investment, right? Check the balance sheet, sir. What is the investment value? 74 lakh. Sir, 74 lakh is the investment value, but we sold it for 75. So this time around, we made a loss or a profit. So this is a profit on sale, which will be transferred off to P&L account, and the profit is 1. First journal entry. Then how many more entries will come related to buyback? 4 more entries. Can we pass that? Or 1 entry, can we cut it off? That is that premium on buyback. Premium on buyback, anyway, we net it off with securities premium. So can I show that shortcut 1 entry here? Okay, so first one, sir. 1 second. Okay, so the journal entry is equity share or equity share capital account. Equity share capital account debit. So how many shares do we have? Again, all these numbers are in thousands or lakhs. I think it's typo here. 1 second. Amount is in lakhs, sir. It's a typo. I have not brought it in. All these numbers are in lakhs. Update that in your notes. All the numbers are in lakhs. It's given in material, but in our, when I missed it out by my end. Update. It's a mistake from my end. So update it off in your notes. Isometer also not given, then how did I write? Maybe old version they gave, no problem. Then you want to keep it as it is, But all these numbers are in lakhs. That will become a little odd. No, write it. That's a typo. All the amounts are in lakhs. Keep it like that. Because they've told investment and all, no full. Right, let it be in lakhs. It's all right. Okay. Equity share capital account debit. Sir, what is your share capital, sir? 12. Yeah, 12 crores. It's 120 lakhs, correct? No? Or 1200 lakhs? What is the number of equity share capital? Can you tell me? Number of shares? Totally, the share capital is 1200 lakh. Each ka face value is 10, means the company has 120 lakhs. Yes. Okay. If you want here, no, all the numbers we'll present it off in lakhs only. I think that'll be easier. So we'll write amount in lakhs, and here everywhere we'll just write the numbers. 75, 74, and here I'll just write 1. Okay. So how much is the share capital given, sir? 1200 lakhs. Is there any premium on buyback here? Premium is there. So, okay. So divided by 10 if I do, what am I going to get, sir? 1200 is the total share capital. Divided by 10 if I do, I'm going to get the total number of shares. This is 120 lakh is the number of shares. Entire thing I'm cancelling, or only 25%? 25%. So if I do this, I'm going to get the number of shares bought back. Multiplied by what? Share capital is always shown at face value, which is 10. How much is this now? 300 lakhs. So you are cancelling equity shares, or simply you can do 1200 ka 25%. That way also you'll get. But anyway, I need to do this calculation for premium on buyback, no? Hence I brought it here also. All right. So, sir, if you want to directly premium on buyback, anyway, we set it off with what? Securities premium. But you can set off premium buyback with securities premium, provided security premium has a balance. So first, if you want to do that shortcut, first you need to calculate that premium and then check whether security premium has enough balance, and then directly do it. If it doesn't have balance, means you cannot do it directly. Okay, so that means you still want to do that shortcut method, or is it okay? Shortcut is okay. Yeah. Then calculate, sir. 1200 divided by 10 will give you number of shares, that is 120 lakh, into 25%. The buyback price is 15. So the extra is 5. So what is that? Premium on buyback is 150. So premium on buyback is 150, but security premium is 175. So we do have enough balance. So that means instead of premium on buyback, directly we can knock off or debit what? Securities premium account. This also ICI does it in few problems. So it's okay. It's an acceptable approach is probably what they're trying to say. Instead of writing premium on buyback first and then transferring that premium on buyback to securities premium, directly you can use security premium. 1200 divided by 10 into 25%. This is the number of shares. And on per share, you're paying 5 rupees extra. So total extra is 150. To equity share buyback account. To equity share buyback account 450. If I do like this, I will get 4 entries for buyback, or only 3? Only 3. Since I've already adjusted premium buyback here, 3 will come. So the next entry will be for CR. So what's the journal entry? Check, do we have any general reserve or revenue reserve? Yes, we do have a general reserve. First of all, tell me, sir, how much CRR will you create in this particular problem? Capital has reduced by 300. Have we issued any preference shares? No. That means capital has reduced by 300. So capital gap is 300. So we need to fill it up by creating CRR to the extent of 300 itself. Do we have general reserve message? Do we have entire 300? We need to create CRR for 300, but balance available in general reserve is only 265. If you have only 265, that means you can only utilize 265. Okay. But we need to create it for 300. So that means there is a shortage. General reserve is not the only free reserve. No. We have P&L also here. P&L we have enough balance 170. But we need only 35. So we'll debit P&L to the extent of 35. The balancing figure basically. Okay. You can use this in any proportion. It's all right. But this is what ICI does it. So if you want to sync up, you can do it. To what account, sir? To CRR account 300. So that's all for your CRR creation. Next is your payment entry. The payment entry will be equity share. Equity share buyback account debit 452. to bank account 450. So towards buyback, we have done all this. Okay. I think here they are given dates also. No? Maybe we'll bring in dates also here. Okay, I think they said we sold the investment on which date, sir? 1st April. So sale of investment entry will come on 1st April. 1st April 20x1. They told buyback and all was completed by which day they told? 5th April. So all the buyback entries you can write it on 5th April. I think till here it's a normal problem, no change. That's all, or one last pitting. Last component is there. If you're finished updating all this, then I'll go for that last adjustment of this problem. You'll create CRR from what? Free reserve. Is general reserve a free reserve? Yeah. Can you use general reserve to create CRR? Yes. How much you need to create CRR for? 300. Do you have 300 in general reserve or only 265? 265. If you have 265, how much will you utilize? 260. Hence, I've debited general reserve by 265. But we need to create CRR for 300. There is another free reserve called P&L. So for that 35, use P&L. Like. Okay, awesome. Now on the last adjustment, on 30th April, the company issued, pay attention to this everyone. This will come in 2 or 3 more questions also. So if you can understand this, next adjustment also will become straightforward. On 30th April 20x1, the company issued 1 fully paid up equity shares of 10 each by the way of bonus for every 4 equity shares held. So they're giving some bonus arrangement. And sir, bonus is given in a particular ratio. Old I will write and bonus. So first of all, what does bonus mean to you? Bonus share means. The word bonus denotes what? Free. OC. OC I think is same in every language. Yes, no. Every South Indian language OC is bitty free only. Yes, no. So bonus shares is nothing but some extra shares given to existing shareholders at free of cost. Company is giving shares to the company instead of giving some dividend. No, they are giving shares itself at free of cost. So if shares are given at free of cost, we'll call it as bonus shares. Has that company done it over here? Yes. So bonus can be given in whatever ratio. 1:1 ratio, 1:10. Meaning if you're holding 10 shares, you may get 1 as bonus. Or 4:3. If you're holding 4 shares already, you may get 3 as bonus. Here, what is the scheme check? The company issued 1 fully paid up equity shares as bonus for every 4 shares held. If you are holding 4 shares already, if you are already holding 4 shares, you will get 1 as a bonus is what the question is telling us. Correct? Yes. Any confusion in that particular component, whatever I've written? Everyone okay? Check, sir. Do you have only 4 shares in your balance sheet? Sir, bonus shares is given to equity shareholders, not preference shares. So only count equity shares. Come to the balance sheet and check how many equity shares do you have. The total share capital is 1200 lakh. Each ka face value is 10. So obviously number of shares is 120 lakhs or 1 crore 20 lakhs. Done. Should I take 120 lakh as a as a figure and calculate it, or one more adjustment? Sir, 120 lakh was the share existing before buyback. You did buyback, yes, no? Sir, bonus, check the dates. You did buyback on which date? Your buyback was completed by 5th April. When are you giving bonus? On 30th April. So on 30th April, do you still have 120 lakh shares or you have lesser number of shares? You have lesser number because 25% of the shares you bought back, no, sir? I mean, do you really have 120 lakhs now? No. 25% you bought back means, can I say only 75% of 120 is remaining? So how much is this? Only 90 lakh shares are remaining on 30th April. That is the date on which you gave out the bonus 20x1. So if you have 90 lakh shares, how many bonus will be rolled out? This calculation. Everyone confirm once. Did we understand? Offline here, all good? Online? How did that 4 come, sir? 4 is given in the question, sir. I didn't create it. Yeah, they only told company issued 1 fully paid up shares for as bonus for every 4 shares held. Here given, see, 1 bonus shares for every 4 shares held. They only told. So if you are holding 4 shares, you will get 1 as bonus. That is the ratio they have agreed upon. I did not create that. Okay, Gurunath Garu. Okay, now. All right. So if you are holding 4, you will get 1. But we don't have 4 equity shares. We had 120 lakh shares before buyback. 25% of the shares you bought back, meaning you cancelled. So that means only 75% is remaining. So 120 lakh or 70% is 90 lakh. That way. Now, okay, someone who said once again, are we comfortable? Everyone, I think a couple of you said that. All right. Others can do these calculations. It's all right. Okay, great. So that means, can you tell me what is the number of bonus shares? We can put this working note as bonus shares. Number of bonus shares is equal to the cross multiplication basically. 90 lakh into 1 divided by 4, which is 22.5 lakh bonus shares. So for journal entry, we want the number of shares or value of shares. So what is the value of bonus shares? Total value, in fact. The value of 1 bonus shares is at 10 rupees. They only told. Okay. The value of 1 bonus shares is at 10 rupees. And for value of 22.5 lakh bonus shares will be 225 lakhs. Can I say so? So you are giving bonus shares worth 2 crore 25 lakh or 225 lakh. For this, we need to pass a journal entry. So if this sort of adjustment comes, put this as a working. No need to present the things in box. Okay. Just present this and then pass the journal entry. Even if you show this box, it's not a problem, but not required is what I'm saying for exams. Can I go ahead and pass the journal entry, or you want me to wait for you to update all this? No, no.
No, sir.
Okay. 90 lakhs saying, huh? We have here one. How much is there? Check your notes. How much we have existing is how much? Existing shares is 120 lakh. How much did you buy back? 25%. So in 100, 25% gone means how much remains? 75%. Alwa? So 120 lakh or 75% is 100. Okay. Or 120 lakh or 25% is how much? 30 lakh. So in 120 lakh, 30 lakh shares if you have bought back, remaining will be 90 lakhs. That way also you'll get it. Whichever way. Someone is saying it is 22.5 lakh or 2.25 lakhs. Is it 2.25 lakhs or 22.5? Others are saying it's right now. Majority of them don't like you. They're suddenly bursting literally. Probably they want to break. That's the reason they're telling like that. Yeah. All right. Look at this, everyone. Stop what you're doing and check the screen for a minute. Sir, bonus shares is given, right? 1 minute. I'll just go one step back. Actually, this was a separate topic, but I'll just give you a little background and then maybe start. Sir, if you have issued equity shares worth 225 lakhs or let's say 2 lakh rupees, what's the journal entry? You have issued equity shares and received money. Forget about application, allotment, first call, final call, wala drama. Tell me in one journal entry, what is the amount? Or what is that one journal entry? Bank account debit to equity share capital. Can I say so? If you have issued equity shares worth 2 lakh, you'll pass this entry for 2 lakh. If it is for 225 lakh, same journal entry for 225. Am I right in saying so? Now, sir, this is a scenario where you have issued the shares and received the money. In case of bonus shares, has company issued the shares? Yes. But is company receiving the money? If company, because bonus shares are given at free of cost. If company has not received the money means, can they debit bank account when they have issued bonus shares? Sir, bonus shares is also normal equity shares only. But the only difference is by issuing these shares, company will not receive any money. But we have to pass entry. So can we debit in this particular case? Can we debit bank? No. But journal entry means one debit has to be there, one credit has to be there. Can we credit equity share capital? Yes. But can we debit bank? No. You will use what to issue bonus shares? Reserves. Company will use the reserves to issue bonus shares. Hence, bonus shares ka another name is there. Sometimes they refer bonus shares as, sometimes they call bonus shares as capitalization of profits. Capitalization of profits, meaning your profit is nothing but your reserves and surplus, no? Correct? That's what they mean by profits over here. Your reserves and surplus will get converted into capital. So basically, instead of debiting bank, if you wanted in one liner, instead of debiting bank, you will debit reserves. Now the next question will be, which reserve, sir? First priority, you already know. Which reserve you will give as first priority for bonus shares? CRR, because CRR has only one and only one purpose, which is to give away. So first priority for your bonus shares is always CRR. If CRR is missing, next priority will be given to securities premium, because security premium has only 5 uses, and one of the 5 uses is to give away the bonus shares. Security premium also can be used to give away bonus shares. Hence, second priority will be given to SP, because SP has 5 utilization. CRR has only 1. So first priority to CRR, next priority to SP. Last priority. If you don't have both of them, then nobody is there, God is there, no? The God for us here is free reserve. Last priority, you will give it to free reserve. That free reserve either could be a general reserve or PL. So we will use this in this order, provided if we require. Are we good, everyone? So basically, the journal entry is, instead of bank account debit to equity share capital, we'll write reserve account debit to equity share capital. Understood, sir? Don't write, hang on. Okay with this? That's the journal entry for bonus shares. Okay. Any doubt till here? Sir, today if you decide to give bonus shares, there will be lakhs and lakhs of shareholders. To everybody, you will give up the shares today only, or there will be some time gap? If today, if you decide to give bonus, maybe it will take week or 10 days to actually put shares to their account, maybe demat account, but still it will take some time. So hence, bonus entry is rooted in 2 forms. First entry will write reserve account debit. We will not credit share capital now only. We'll park it in one dummy called bonus to shareholders account. Or you can simply write bonus account. It's okay. This is a dummy account. Okay. Suppose in this problem, you're giving bonus. Guys, shh. You're giving bonus for how much value? 225 lakhs. Check here. First priority to, or 1 minute. First we will, or I'll finish off the sample entry, then pass it once again for your reference. So you'll write reserve account debit to bonus to shareholders account. Is this actual account or is this a dummy again? Because there is a time gap between the day you pass the resolution to issue the bonus and the actual date when the bonus shares is given, it is allotted like this. So this is a dummy account. It should stay or it should get cancelled. So that means next entry will be bonus to shareholders or equity shareholders also you can write. It's okay. Account debit to what account should actually be credited? Bonus shares is also normal equity shares only. That means you should credit equity share capital account. On the day you declare the bonus, you will pass this entry. On the day actual bonus shares are issued, you will pass the second entry. That is the time. Generally, the time gap may be 2 weeks or 3 weeks at best. Okay, sir. Now, same thing, we'll have to bring it into this particular adjustment. Everyone got the background? Can I finish this up? Again, let's go one step back. Bonus shares means what, sir? It is a shares given to whom? First of all, it is what sort of shares? Equity shares or preference shares? Equity shares. Given to whom? Existing equity shareholders. At what? For money or free of cost? Free of cost. So you will use what to give away bonus shares? Reserves. What reserve is the or what is the priority order? First is CRR. Why? Because CRR has only one purpose. Second, SP or SPR also you can call it, security premium reserve, because that has 5 utilization or purpose. Last will be your free reserve because they don't have any restriction. So is 1 entry for bonus or 2 entries? Basically reserve account debit to bonus account, then bonus account debit to equity share capital. Either you can call it as bonus or you can call it as bonus to equity shareholder, bonus to shareholder, whatever, it's fine. Can we do that now? come back to this question and tell me which reserve. You gave the bonus on 30th April. Which reserve will we use in this particular case? I'll show you the question. We have SP also maybe. We have general reserve also. We have CRR also. We have P&L also. We have everything. Which one will we use? Sir, we already had a CRR of 200. We did a buyback and we created a further CRR of 300. Total CRR available with us is 500. 200 already there, 300 created now. We have 500 balance or 500 lakh balance in CRR. How much we need for bonus? 225. So is there any shortage or we have enough in CRR itself? We have enough in CRR itself. So should we have to use a security premium or any other free reserve for bonus? Not required. So the journal entry will be what? CRR account debit. We'll write working note number 1. How much is the value of that bonus shares? 225 lakhs. So CRR account debit 225 lakhs or just 225 because anyway all the numbers are in lakhs to what account? Either you can write bonus or bonus to shareholders account, which is 225. They've not given any further date. So the next date also I'll keep it same. Next entry will be what? Bonus to shareholders account debit 225 to equity share capital 225 lakhs. 225 lakhs. Sir, suppose you had only 200 in CRR means? Suppose you had only 200 in CRR means? Balance 25, you will check if balance is available in securities. Suppose there was only 20 lakh balance in SP means? Then CRR account debit 200, SP account debit 20. For the balance, the shortage, use a free risk like that. That is not applicable in this case, but that scenario also they can make it. Okay. He's saying, sir, what if you don't have enough balance at all? Such companies won't go for bonus because to issue bonus, we have to have reserves. If they don't have reserve, they'll not think about bonus. Okay. Someone is saying now outside liability is not affected. No, when you issue bonus shares, check here. When you issue bonus shares, what is getting credited? Equity share capital. That means 225 lakh worth of shares if you have got means as a shareholder, you will be little cautious in your voting. Because now again money is invested in the business. Though you did not invest it, those shares came for free. But still you are entitled for this. That share ka value is 225. That means, would you like to send the business down the drain to Kengeri Mori? No, right? You would want to be a little careful so that business survives and you get a lot more money. Yes or no? So that means you will vote consciously. That way outsiders will be protected as well. Okay, now? Alright. What is the purpose of issuing bonus shares? Their company has a lot of reserves. They don't know what to do with the reserves. Hence, what to do? Give out one bonus and get on with it. That could be one reason. Their call as such. It's not that. See, again, these are, you could say, think on those lines. Another thought could be, when you wanted money, shareholders gave you the money. Wouldn't you want to protect or give something back to the shareholders? They feel good about it, right? So if these are all some generosities which the companies do to keep the shareholders happy. Could be. Yes, multiple ways. You can look at it in different angles. There is merits to both all of this also. Yes, sir. Everyone has got, coming back to the question, everyone has got the question and its treatment unanimously, no doubt. This bonus ka fitting also is clear for everyone. So we'll take that much awaited break. So 20 minutes is good. Well, it's about 6:10. Can we resume back at 6:30? Okay, thank you.